Thank you for joining us today at AAFCPA's Individual and Family Tax and Wealth Preservation webinar. Our goal for this afternoon is to help you equip yourself with the tools and insights needed to optimize your year-end and long-term tax and financial planning. My name is Rich Weiner. I am a tax partner in our transaction advisory and commercial tax groups, and I'll be moderating today's session. Before I introduce our speakers, I'd like to quickly cover a few housekeeping notes. First, we encourage questions at any time via use of the question Q&A on your screen, and we will work them in at the end of the session as time allows. For those of you who are CPAs, today's session qualifies for 1 credit. In order to be eligible, you will need to answer 3 out of the 4 polling questions that will pop up periodically. In addition, you will need to complete the evaluation that will pop up at the end of the session. We will email CPE certificates to you within 3 weeks. The slides for today's session will be made available in the chat for you to download, and the webinar is being recorded for you to watch again or share. So without further delay, I'd like to invite our speakers to introduce themselves.
Thanks, Rich. My name is Dan Seaman. I'm a tax partner in our high net worth niche, and also I work with Jonathan and the clients on the wealth management side for their tax needs.
Good afternoon. My name is Jonathan Bloom. I am a partner at AAFCPAs and AAF Wealth Management.
Good afternoon. I'm Josh England. I'm a partner at AAFCPAs, and I head up our Trust and Estates Department.
Hello, everyone. My name is Tyler Champagne. I'm a tax manager here at AAFCPAs. I'm a leader in our closely held business and entrepreneurial tax department, and I focus on closely held businesses and their owners.
Great. Thank you, everyone. And with that, I will turn things over to Dan and John.
Thanks, Rich. So as we mentioned, Dan and I mentioned earlier, we are partners in the wealth management practice. We truly believe in holistic approach to financial planning, and this includes the integration of tax planning, financial planning, investment management. So today we're going to talk about some things that are top of mind, both from a tax standpoint and a financial planning standpoint. So Dan's going to kick us off today.
Thanks, John. So let's start with, so far, what has stayed the same from 2023 into 2024. So for starters, there's still a cap on total state taxes that you can pay. So this is real estate taxes, state taxes on the tax return, everything along those lines. Those are still capped at $10,000. You still have a mortgage interest limit that's $750,000 for all mortgages after December 15, 2017. You still receive no tax benefits from miscellaneous itemized deductions, and we still have the increased standard deductions and no exemptions. I'm going to get to how this might change in the future in a few slides, but for right now, that's how everything stands. So when we talk about those increased standard deductions, here's what they look like. So for single people, I'm going to focus on 2 areas, single and then the married filing joint for right now. So for single people, the total standard deduction is $14,600, and for married filing jointly, it's $29,200. Meaning that in order to itemize in either of those cases, you would need more than the standard deduction. And that comes into play as it relates to charitable contributions, right? So where the standard deduction is so high, what we're kind of seeing across the board, and this has been that way for the last 4 or 5 years, is that less and less people have chances to itemize like they would before, right? Because that standard deduction is so high. So there are ways around that. And one of the ways that we can do that is to do what's called stacking donations, right? And use what's called donor advised funds. So I'm going to kind of walk you through an example of how that works and what the benefit of that is and why it's kind of a crucial tax planning technique. So let's take a look at just a normal year for a taxpayer, right? This is a married filing joint example. So as I said before, the standard deduction is $29,200, right? So let's assume that that person has maxed out those state taxes at $10,000. They have about $6,200 of mortgage interest, right? So $16,200, and then they give a $15,000 worth of charitable contributions, right? So they're at about $31,200 of total deduction. So they're $2,000 over the standard deduction. So at a 35% tax rate, that yields a tax savings of approximately $700. So let's take that a step further. Let's assume that that person does the $15,000 a year. They have everything the same from the mortgage and the taxes, but then they keep doing the charitable contributions at 15 grand a year over the course of 3 years. That puts them at 2K over each year. That would be the $700 each year of tax savings times 3, so it would be $2,100 of savings. So now let's assume that that person instead does the whole bunching or stacking of donations that we talked about before, right? So what they do in this case is they say, okay, instead of giving charities $15,000 a year over 3 years, I'm going to do everything up front, right? And so oftentimes people say, well, I don't want to do that because I want to be able to control when the charities are getting the money. So what you can do in that is use what's called a donor advised fund. We're going to talk about ways to fund it in a second, but what you can do is instead of giving the $15,000 a year to the charity each year, you give $45,000 to the donor advised fund. And then over the course of years, you can do contributions from the donor advised fund to the charity, but you get that deduction up front. So in the example that I just gave, instead of doing the $15,000 a year, you do $45,000 all in year one. So you have $45,000 plus the 10 and the 6,200. You're now $32,000 over the stated deduction, right? So that tax savings is $11,200. So as you can see, it's a much powerful way to get that deduction up front. And then the next 2 years, you can just take the standard deduction.
That's great, Dan. So there are a lot of great ways to fund accounts like this. And, Dan mentioned you can get that large deduction. Another way to even make that deduction even better would be by contributing appreciated assets to something like a donor advised fund or directly to the charity. So when we're talking about appreciated assets, we're thinking about things like stocks or mutual funds that have gone up in value, business interests. It can actually be real estate, any of those things that have gone up a lot in value. You give directly to the charity, so you never have to pay long-term capital gains on those assets. Another great way is something called a qualified charitable distribution, which Dan will get into in a minute. It's actually the most effective way to give to charity, followed by the least effective way to give to charity, which would be cash.
Thanks, John. So the donor advised fund is one way to definitely fund charitable giving and to stack donations. Another great tool is what John had mentioned before, which is the qualified charitable distribution, or commonly known as a QCD. That's what you'll hear it used as. So what this allows you to do is you can distribute up to $100,000 directly from an IRA. You have to be 70 and a half years of age or older. So this is regardless of reaching RMD age, required minimum distribution age or not, you're able to do this. But when you are in RMD age, these distributions count toward your RMD for that year. So it can be a really powerful tool. And any distributions that you give directly to charity. Now, the key is it has to go directly to charity. So you can't take the distribution and then give it to the charity. You have to write it directly from the IRA to the charity. But then that distribution doesn't count as income. So again, it's another tool to kind of lower your taxable income in that year, and still take that standard deduction, which we talked about is fairly high, but also be able to still get a deduction for that money given to charity. Now, again, as I mentioned, there are some downsides, or not downsides to it, but things you have to be careful about. So again, the funds must go directly to the charity. For married couples, each person has a $100,000 contribution limit. The middle bullet point here is probably the most important one. The IRS does not have a means right now to track these donations. And to track when these happen. So what you need to do is make sure, and the report you'll get at the end of the year for any distributions from your IRA will have the taxable income on it completely. So you need to let your tax preparer know, and I work with Jonathan closely on this, to say, okay, of that, this is how much were QCDs that went directly to charity. So really right now, there is no mechanism to track it other than on the taxpayer. So make sure you track those donations and make sure you give them to your tax preparer so that it's covered in there.
Yeah, so let's transition to some ways to save on taxes while you're still employed, right? So one of the greatest benefits out there is something called an HSA, or a health savings account. So this is a medical account that can be used to save away money for current or future medical costs. There are a couple caveats in being able to get into these plans. So first, you must be enrolled with a qualified high deductible health care plan. So if you don't know if your plan is considered high deductible, you would just need to check in with your health provider, or possibly HR at your company. You do generally want to be, you have to be before age 65. You generally want to stop contributing to an HSA around 64 and a half. But the neat thing about HSAs is they are triple tax free. So it goes in pre-tax, grows tax free, and comes out tax free. And it does carry over from year to year. So you can think about this as another retirement account that's meant for medical expenses. Some people ask, oh, well, should I be spending it year to year? If you can afford to, max out an HSA and not spend it until retirement, it can be invested for a long time and grow up to something that's really nice come retirement. Another one is the flex savings account. So if you're contributing to an HSA, you can't do an FSA. But again, this is a plan that's available through employers. You can put up to $3,200. You do not need to be in a high deductible plan. So this one is available to most people, that it's available through their employer. It does have to be used for qualified medical expenses, but this is not one that you can think of as a future plan. You can carry $640 from year to year, but don't plan on just try and spend the entire thing. Another great one, especially for those with young children, is the Dependent Care Flex Savings Account. So again, this is another plan that's available through employers. With this plan, you can put up to $5,000 in per year that can be used for items like preschool, day camp, after school care. For those parents out there, this is probably good for only 1 or 2 months worth of care, but it is still a good way to save a couple $1,000s in taxes when you're paying for all these benefits pre-taxed. Keep in mind, you need to spend this throughout the year. No money can be rolled over from year to year. And then probably the most common one for lowering your taxes throughout the year is going to be retirement contributions. I'm sure you're all aware of them, but this includes contributing to 401ks, 403bs, IRAs, and then there's also some other retirement plans for those of you which are self-employed.
And then one other technique that's still out there is for people that want to do Roth IRA contributions, but they've kind of hit the limit on income, right? So as everybody knows, in order to contribute to a Roth IRA, your income has to be a certain level. When it goes over that level, what you can do is what's called a backdoor Roth IRA. The IRS has come out and said they're fine to do, and you can do them. So what you do is you set up a traditional IRA, you make a non-deductible contribution, and then you convert that amount basically the next day or within a week. The caveat to this is the last bullet point. It only works well if you don't have other IRA money. And what I mean by that is when you go to do the conversion, it takes your total IRAs over the non-deductible piece and prorates it. So if you have other IRA money, it could make most of that contribution end up becoming taxable when you go to roll it over. So you just got to be careful of that. But for those without IRAs, it works. The other key component into this is you must have earned income. So you can only contribute up to your earned income on that.
Great point, Dan. So speaking of having earned income while in retirement years, there's something that's not talked about a lot that really should get more attention, and it's called IRMA, which is Income Related Monthly Adjustment Amount, which is really what it sounds like. Depending on the amount of income that you have post 65 determines how much you pay for Medicare. So what we're going to do today is take a look at a couple examples of how much your income is and how much Medicare will cost you. So on the next slide, there's three examples. Couple number one, couple number two, couple number three. I apologize for those of you who are not in couple for this slide, but the example stays true either way. So this first couple, if you take a look, their income total for the year is $200,000. That puts their monthly Medicare premium at about $350 per month for both of them. At $200,000 of income, they're not going to have a monthly Part D surcharge. So that annualizes their Part B and Part D total to about $4,200. If we take a look at couple number two, they had an additional $60,000 worth of income. Because of that, their monthly Medicare Part B premium actually doubled. They then also have a monthly Part D surcharge of $66.60. Which put their annualized amount for B and D all the way from $4,200 to $9,200. We're going to take a look at one other couple and then dig in a little more into that one as well. So similar to couple one and two, they have a good income during retirement, but they also sold their house, so their income jumped. So if we take a look at what that did to Part B rather, it moved it up to almost $1,200 per month. Their surcharge for Part D went up to about $150 per month. That put their annualized total at about $16,000, all the way up from $4,200. So an extra $12,000 per year or $1,000 per month is a significant expense to people in retirement. So let's dig into number three and why it went up so much, right? So at the sale of a primary home or any of these other examples, a recent retirement, divorce, when your income rises, you could be subject to that IRMA increase for your Medicare expenses. So there is something that you can do. You can request a reduction of IRMA through the Social Security Administration in case of some of these events. Again, a sale of a home or recent retirement, a divorce. If you did have a loss of income, maybe a settlement or a death in the family, it is worth researching to see if you can have a temporary reduction of your Medicare cost. The real best practice, right, is in the current year of that you have IRMA, you can try and reduce it or try and reduce your income for the year through things like charitable giving, like Dan talked about, harvesting losses in some positions that are down, not taking gains, or making retirement contributions. But the best thing that you can do is long-term planning. So let's look at a couple of options for what you can do. First would be some great gap year strategies. So if you have time between when you retire and when you're of RMD age, here's some ideas for you. So one would be a partial Roth conversions. So by doing partial Roth conversions, you would lower your RMDs in the future. You could use up lower tax brackets, and of course get the benefit of tax-free growth within IRAs. Some drawback would be that you would have more taxable income during that current year, but again, hopefully you're using up those lower tax brackets. Another idea is potentially delaying your Social Security income. Benefit would be that you would get higher payments down the road, but you do get some extra flexibility in those gap years. But the downside, of course, is you do have less current income. Another idea is for those years that you really do have no income, you do have the potential for having 0% long-term capital gain rates. So if you do have zero income, if you take a look at the chart below, a single person can have up to $47,000 of capital gains with no other income at a 0% rate. So it's the importance of integrating your wealth management with your tax planning to make sure that you're taking advantage of these lower rates whenever possible. And then again, with charitable contributions, you get that good feeling of helping out. The drawback would be the obvious reduction of assets.
Thanks, John. So we've talked a lot about kind of ways to reduce taxes and to kind of benefit from those gap years and everything like that. Now let's look kind of ahead of what's to come, right? So obviously, we don't know what the future holds from a tax standpoint. We have an election coming up. We're going to do a webinar on that going forward. However, let's look at what we do know. And what we do know is that as of December 31st, 2025, all of the Tax Cuts and Jobs Act tax rules are set to sunset. So what does sunset mean? Sunset means that it is going to go back to the way it was before the Tax Cuts and Jobs Act, right? So some of those key parts of this would be tax brackets. They're going to go in, they're going to increase again, right? So right now, the highest bracket is 37%. It's going to go back up to 39.6%. The estate tax exemption, and we're going to get into this in much more detail when Josh talks in a little bit, that's going to be nearly cut in half. Miscellaneous itemized deductions will come back. The tax cap on itemized deductions will be removed. This is good and bad, and I'm going to explain this on another slide. But right now, where it's capped at 10 grand, right, you don't get to deduct all your taxes. However, taxes do get added back for alternative minimum tax purposes. So some cases, people were not even deducting the state taxes to begin with. So removing the cap may not be all that beneficial. Couple of other things that are set to sunset. The standard deduction will go down. So that big deduction we talked about at the beginning of 29 grand is set to go down. And exemptions will return, right? So more people will start to itemize again. The middle point here is also incredibly important. The child tax credit is actually set to reduce to $1,000. It's currently at $2,000, right? Which doesn't seem like a big decrease. It's a decrease of $1,000. It's cut in half. The bigger part of that is right now, it does phase out when people's income is over $400,000 for married filing joint. Barring something that changes, that phase out is going to start at $110,000. So in reality, not only is it getting cut in half, but more people could phase out of it. So that's a pretty big deal on that one. And then the last one is the alternative minimum tax, which I talked about, right? So the way I always think of alternative minimum tax is you calculate your tax two ways and you pay the higher of the two, right? And the tax, and for alternative minimum tax, there's certain add backs. The add backs there are, for instance, the state taxes that I talked about. So what's going to happen is right now there is an exemption on alternative minimum tax that's currently $133,000. What's going to happen is it's going to go back to the pre-Tax Cuts and Jobs Act levels and down to $86,000. So what does that mean? It means more people will be subject to AMT in the future than they were before. And so, what can you do to kind of plan with this potential sunset, right? You have a couple years. You could look at accelerating income depending on what your brackets are now. Tax rates could go up in the future, so maybe take advantage of lower tax brackets now. Estate planning, this is probably one of the bigger ones. And again, Josh is going to talk about this in a lot of detail later, but that's something to definitely look at. And then the other one, and it's kind of what John and I have kind of talked about across the board, which is really conduct your tax and financial planning and your overall assets now and figure out a plan and structure it. Could it be taking advantage of those gap years, knowing that tax rates are down? Different things like that, right? And there's so much overlap with the two. That's why we're kind of saying you really want to look at it holistically. And that's how we've always looked at everything. So that's, again, another potential that you could do with the sunset. So we've talked a lot about federal and everything along those lines. Let's talk a little bit about Massachusetts, right? So last year was the first year in Massachusetts that we were allowed to deduct charitable contributions. That still holds true. Key point here is that it can only be used to offset Part B income, right? So ordinary income. Part A and Part C income, which is interest and dividends and capital gains, it can't be used to offset that. And then there's also the mass millionaires tax, right? So we're in year 2 of this now. So again, it established an additional income tax on income that exceeded $1 million. It was effective as of 1/1/2023. So last year was the first year on it. This is year 2. So the key on this is that at the end of the day, it's only income that goes above $1 million, right? So for example, if you had $1.5 million of income, the first $1 million is taxed at 5%. The next 500,000, it would be at 9%, the 5% plus the 4%. The other thing to note too is the $1 million is adjusted for inflation. So right now it's a little over $1 million. It's about $1,053,000. But just know that it's not like once you go over, it's a cliff and every dollar is taxed at 9%. It's only the amount over the $1 million or $1,053,000 in this case. So what can you do to try to avoid this, right? So the first thing was last year when this came out, right? The first step was, well, if people just file married filing separate for Massachusetts, hey, we each get $1 million exemption, right? It sounds great. Well, as part of various tax changes in Massachusetts, and Josh will go across this too with the increased exemption, what Mass said is going forward, you can only file married filing separate if you do it federally. Generally, I mean, there are reasons that you would file married filing separate for federal. Generally, it's not an advantageous bracket federally, so you're generally not going to do it for the state. So that idea has kind of been tossed out the window. We had 1 year at it. It was in 2023. Going forward, we're not going to be able to do that. But there's other ways to spread out income, right? So you can still do insolvent sale, state apportionment, relocation, so moving out of the state. Again, it's a life change too, though, and that's what I always try to say to clients is it's not just about the tax implications of it. It's about also, changing your life, changing where your social circles are, a lot of different things. And then also use trusts, because trusts could each have their own $1 million exemption. With all this, what I would also say is don't let the tax implications of something ruin a deal or do anything like that. Be aware of the tax consequences of it, but look at it from a business side too.
Thanks, Dan. Yeah, so we went over a lot of things during this presentation in regards to year-end strategies. So we touched on Roth conversions, tax loss harvesting, trying to max out contributions throughout the year. But as we do head into this last part of the year, I think it's very important to revisit your asset allocation. Take a look at portfolio drift that we may have had throughout the year. There's been a lot of things moving in the market. A lot of things have moved in the right direction together this year. So again, revisit that portfolio drift. Make sure you're still taking on the amount of risk that you want to. And as always, the end of the year is a great time to revisit your financial plan. Make sure things are looking the way that you would expect them to look. We did have one quick question that I did want to address. So for the HSA, you can still contribute as long as you're in a high deductible plan. Now, when you become 65, which is Medicare eligible, Medicare is not a high deductible plan, which would prevent you from contributing to the HSA, which is part of the reason that 65 age is there. So I'll hand it back to Rich.
Great. I'd like to thank you both. That's a great presentation. Just a couple of other comments to pick up on the question regarding HSA and Medicare. Be sure to speak to your insurance advisor and your wealth manager. There have been strategies where people can defer signing up for Medicare Part A in order to continue contributing, but it is something that you have to be very specific in your approach. So it's not a blanket yes or a blanket no. On some other items, the 2025 tax rates were announced within the last week after these slides went to press, and watch your email for more information on that regard. With regard to donor advised funds, and this is something that we see in the transaction advisory practice, if as a business owner you are contemplating a sale within the next 12 to 18 months, while getting valuations and before signing any letters of intent, there is a strategy where you can donate a piece of your business to the donor into a donor advised fund as a means of permanently excluding that gain and funding the account. The process is very specific, and be sure to consult with us if you're looking to go down that path. Lastly, with regard to domicile and a change of residence that Dan touched upon near the end of the presentation, when you move out of state, as he mentioned, it's a lifestyle change, and revenue agents are very aggressive in asking questions about people who do move out of state. They look at the concept of domicile rather than simply residence. So you can do everything right in terms of spending more days out of state rather than in state, so on and so forth, but they ask the question about whether your domicile has changed. And interestingly enough, one thing states are looking at these days is the use of cell phone records that will ping your phone and tell you where you are. So again, the poll is up on the screen if you haven't yet answered it. And in the meantime, I'm going to turn things over to Josh.
Thanks, Rich. Thanks, Dan and John, for a great discussion. I'm talking about the estate tax while Dan and John have been talking about income taxes. It's two separate taxes. The estate tax is a tax on the fair market value of your assets at your death. Massachusetts is one of 13 states that has an estate tax. Currently, Massachusetts has a $2 million exemption, meaning that you can die with up to $2 million of assets in your name or having control over. And that's not subject to that Massachusetts estate tax. Everything in excess of that $2 million is subject to the Massachusetts estate tax. And that estate tax is a graduated rate anywhere from 4% up to 16%. Unlike most of the federal numbers, the Massachusetts estate tax exemption is not subject to inflation adjustments. And so we're looking forward to just using that $2 million going forward for a number of years now. It did just recently changed. It moved up from $1 million to $2 million. And so Massachusetts went from having the worst estate tax in the nation to the third worst. We now beat Rhode Island and Oregon. Yay, Massachusetts. Moving on to the next slide. So they also changed the method by which that estate tax is calculated. As I said, Massachusetts used to have a $1 million exemption, but that was a cliff, meaning if you had a $1,100,000 estate, you were still taxed on that entire $1,100,000 for a tax of $38,800. And if you had a $2 million estate, that tax was as much as $100,000. Today, they've eliminated that cliff. So if you die with a $2 million $100 estate, a $100,000 estate, that estate tax is only $7,200. So there's definitely been a change there to your advantage. Massachusetts also does not have portability, meaning each of you have a $2 million exemption. On the federal side, if your spouse dies, you can potentially inherit their estate tax exemption. For Massachusetts, you can't. So if you have what I would call I love you wills, where you leave everything to your spouse, at the death of the first spouse, their $2 million exemption is never used. So the surviving spouse now has all of the assets in their name, and at their death, again, you only have one $2 million exemption available to avoid or eliminate that Massachusetts estate tax. With proper planning, we can institute trusts so that at the death of the first spouse, we can segregate out that $2 million so that it's not subject to the estate tax at the death of the first spouse, and it's not subject to the estate tax at the death of the second spouse. So what that means is really make sure you talk to your AAF advisor to make sure that your estate planning is properly structured to maximize the use of that Massachusetts estate tax. Massachusetts also finally has acceded or agreed to what the Supreme Court told us several years ago, which is Massachusetts can only tax non-residents on assets held inside of Massachusetts. So if you're a New Hampshire resident or a Florida resident and you own real estate here in Massachusetts, Massachusetts can still tax that real estate and subject you to that Massachusetts estate tax. And so as an example, assuming you had a $10 million estate and your Massachusetts real property was worth $2.5 million, or 25% of your estate, if you were a Mass resident, that estate tax would be close to $1 million on that $10 million estate. As a non-resident, the estate tax would only be $242,000, 25% of that $968,000 number, or the value of that Massachusetts real property. The reason I bring this up is so if you're not a Massachusetts resident and you own real estate here in Massachusetts, there's planning we can institute today so that you're not going to be subject to that Massachusetts estate tax at your death. And so again, with proper planning, we can save you or your heirs as much as $250,000 in tax using this example. So again, talk to your AAF advisor about how to structure your estate for maximum savings. On the federal side, there's also a tax, and that exemption currently for 2024 is 13.6 million. Next year, it goes up to 13.9 million. And in 2026, it's going to be cut in half to approximately 7 million. And that's, again, goes to those sunsets that Dan talked about under the Tax Cuts and Job Act. The annual exclusion amount, the amount that I can give away to every individual without starting to take advantage of my federal estate tax exemption, currently is 18,000. Next year, it will go up to 19,000. And so the takeaway for you, and what we're going to focus on a little bit here, is that you need to use that $13.6 million or $13.9 million estate tax exemption today before it is cut in half. So for example, if I gave away $5 million today, using up $5 million of my estate tax exemption, and the exemption goes down to $7 million, after that, I'll only have $2 million exemption left because it's from a bottom up. So if I have a $7 million exemption and I've used up $5 million, I only have $2 million left. If I have used up $13 million and it goes down to $7 million, I have zero left. But I will have removed $13 million from my estate for estate tax calculation, as well as all of the appreciation on that $13 million. So what can you do to make those gifts? Because a lot of people say to me, Josh, I don't want to give away $13.6 million because that's my money and I've used it and I want to have access to it and I want to enjoy it. And one way to do that is to set up what's called a spousal lifetime access trust. That's essentially, I create a trust for the benefit of my spouse that my spouse controls, and my spouse is the primary beneficiary, and my spouse can continue to enjoy those assets. And I make a gift of $13.6 million to that trust for the benefit of my spouse. And so therefore, I can still have access and enjoyment and enjoy the use of that property through my spouse. Now, if my spouse should predecease me, there are ways that you can step in and continue to enjoy the use of those assets as a continued beneficiary of that trust. What does that look like from an estate tax point of view? If I'm a married couple worth $20 million today I enjoy a $27 million exemption. So if I die today, there's no federal estate tax on my estate. From a Massachusetts point of view, that married couple, the death of the surviving spouse, there'd be $2.5 million of estate tax. If I do nothing and my estate continues to grow, in 15 years, that $20 million estate could easily be worth $41.5 million. And again, if I've done no planning, the estate tax, the federal estate tax on that could be as much as $19 million. And the Massachusetts estate tax on that could be as much as $13 million. So it's a significant impact to your heirs. And so if I've created a slat and put my $20 million into that trust, the estate tax would be zero. So I think your heirs would agree that they would prefer not to have to pay the federal government $20 million on your death. So this is what that spousal lifetime access trust looks like. And I would again encourage you to speak to your AAF advisor on how to go about setting that up. From the federal side, there is what's called a step up in basis. If I die owning an asset, then that my heirs will receive that asset with what's called a step up in basis. And that can be very advantageous. So it's something that we need to consider as we're discussing the various estate planning options out there for you. And one of those ways is through what's called the upstream trust. And so again, if you have a highly appreciated asset that you're thinking about selling, I would encourage you to speak with your AAF advisor about the different kinds of tools that might be available to help assist with reducing the income tax on the sale of those highly appreciated assets, and one of those could be through the use of what we call the upstream trust. There's other trusts that are also available, what's called a DING trust, the Delaware Incomplete Non-Grantor Trust, and that can really come in handy when we start thinking about that Massachusetts millionaire's tax. As Dan mentioned, one of the tools available to us is to spread that income out over multiple entities, because each one of those trusts can have their own $1 million exemption, thus reducing that Massachusetts millionaire's tax. It can also be used to eliminate the state income tax on the sale of a highly appreciated asset, such as your business, or for multiplying what's called the qualified small business exemption, which is another great tool, tax planning tool that I'm sure you heard about yesterday if you listened to our business tax planning webinar. And if you haven't, I would encourage you to go back and listen to it. It's available on our website. With that, I'm going to hand things back over to Rich.
Great. Thanks, Josh. Great presentation. Just had one follow-up question regarding slats. I mean, oftentimes married couples will set up trusts and then relocate out of Massachusetts, whether it be to a low tax jurisdiction or even another high tax location for family reasons. What happens with these trusts? Do they need to be rewritten, or what's the process?
Well, so a slat is an irrevocable trust, meaning that when we create it, it's not changeable down the road. Now, we do build in a lot of flexibility into those trusts, and oftentimes we set up those trusts in what we would call a trust-friendly state, be New Hampshire or Nevada or Wyoming, because those have significant benefits of setting up those trusts in those other states. So if a client moves to Florida, for example, and they have these slats that we set up that are New Hampshire trusts, no, there's not really any significant changes that need to be made. We would encourage them to look at their other estate planning documents, such as a durable power of attorney or their will, which probably will require some sort of change. But fortunately, when we're drafting those slats, they are designed to be effective in just about any state in which you might move.
Great. Thank you. Great information. If you haven't answered the poll yet, please do so. And I will turn things over to Tyler Champagne.
Thanks, guys. So I'm going to revert back to the income tax, kind of move off of the estate tax here today. What I'm going to go through is just a handful of tools and reminders for folks that have businesses. And the reason that we're going to go through that today in the individual estate trust webinar is simply because pass-through entities do affect a good chunk of individuals and trusts who do have beneficial ownership in a partnership or an S corporation where profits are reported on their own individual trust or income tax returns. So first up, we have the reduction of bonus depreciation from 80 to 60%. This is part of a planned reduction from 100% pre-2023 all the way to 0% when we hit 2027. Just because this deduction is decreasing, it doesn't mean that the value is not there. Trusts are mostly affected by accelerated depreciation. Certain choices may affect the ability to make deductions. We have the deduction for self-employed health insurance. So this is sometimes often overlooked for self-employed individuals or folks with S corporations. We usually see health insurance premiums, it's just the premiums that you pay on a typical traditional health insurance plan. But it's really helpful to remind you that long-term care premiums, medical, dental premiums, even your Medicare premiums can be deducted from your adjusted gross income to reduce your tax burden. If you are an owner of an S Corp and you lend or have lent money to that S Corporation, it would behoove you to create a bona fide loan. New in 2021, there was a form that says if you have debt that is formal, in other words, it's an obligation to repay something at a fixed increment at an interest rate, versus an open account where it's just money, kind of like a tab where you can put money into the business, you can take it out. There's those two different components to lending to your company. Sometimes if you're going to take money back out as a repayment of that loan from your S corporation, that repayment, a portion of it will be taxable in certain circumstances. When you have a bona fide loan, you're actually eligible to have a preferential tax treatment, in other words, long-term capital gains rates, as opposed to the open account or the open tab where it's taxed at ordinary rates. We also want to continue to be vigilant with research and experimental expenditure changes. I know this isn't brand new. We've had to deal with this for almost 2 years now. However, it's something that we do want to bring to the forefront because those of you in the R&D space, you may be needing to capitalize research and experimental costs over the course of 5 years or longer in some circumstances. So it's just very important to keep an eye on this. The IRS has clarified some aspects of this area. So one that I've seen recently, software as a service, SaaS companies, if you're debugging software or you're doing something as routine maintenance, there's a possibility that you actually don't have to capitalize that, which is an excellent boom for folks that are trying to get deductions to grow their business. Finally, we have components of qualified business income. So just like a couple other things that Dan was mentioning, this is set to sunset at the end of next year, so December 31st, 2025. However, this is a great deduction in the interim. It's essentially just a function of wages, business income, and property owned. And through thoughtful planning, you can actually increase this deduction and reduce your tax burden for the current year. And I'll bring in my shameless plug for our business transaction advisory team, which I am also a member of. We just wanted to bring up a couple of hot topics that we've seen recently that are in the space of sales. I'm just going to ignore mergers for now, but when you're selling your business, generally speaking, you're going to go through an asset or a stock sale. I have a couple of just high-level characteristics on each of these. Asset sale, you're going to see a combination of your ordinary and capital gains rates. With a stock sale, it's going to be mostly, if not all, capital. And so in a vacuum, if you're looking at an asset sale, it's generally going to command a higher sales price. And that's just because of the tax attributes that are known on the sell and the buy side, that the buyer may actually get to accelerate some depreciation. They might get a better accelerated benefit versus the seller. In comparison to a stock sale where you're going to have a generally lower sales price. But if you look at that first row, you're getting capital gains rates. So right off the bat, if you're in the max bracket at 37%, you could be saving up to 17% in tax just on the sale of stock. Tax planning opportunities. There's really no shoe-in for type of sale that you want to target, but there are different opportunities for each. For asset sales, it's price allocation. You're buying assets. Depending on how you divvy everything up into different buckets, you could save a bunch of money. I know it sounds like a Geico commercial, but you could save a bunch of money by putting things in different brackets for tax purposes. On the stock side, however, there is an enormous opportunity with gain exclusion. So the gain exclusion can actually be up to 100% of the gain that you realize on the stock sale of your company. This requires a lot of foresight and planning. So if you're looking to take advantage of that, you can't say, well, I'm looking to sell my business in a month, so let's get rid of this tax. This is something that does happen over the course of time. Generally speaking here, in either an asset or a stock deal, you want to be proactively maintaining your books and your financials. I kind of equate this to taking care of your car, preventative maintenance. It's oil changes, the tires, anything that might go along with keeping your car in ship shape. Once someone goes and looks under the proverbial hood of your business, if they see some stuff that are red flags, that's going to drop that sales price. And this is something that we have seen, and it negatively affects the seller's position. Consultation timing. Obviously, I kind of alluded to this with a stock sale. Your time horizon, if we want to take advantage of that gain exclusion, you're going to have a 5+ year time horizon. Asset sales, of course, it's a little bit more flexible, but at any rate, with any of these types of sales, you want to be on top of it. You want to make sure that you're planning ahead so that you can take advantage of any outsized tax savings opportunities that are available to you. And speaking of tax advantages that are available to you, so the pass-through entity tax, generally this is available for partnerships and S-corps through 2025. Dan had mentioned earlier the state and local tax cap at $10,000. This is a tax that was implemented by the states when that state and local tax cap was implemented as well. And it was a way for the states to give some sort of benefit to folks that are operating within their borders. So what it does is if you think about this just from real estate taxes, so state and local tax includes real estate taxes and your income tax. If you are paying $10,000 or more in real estate taxes on your home, you are getting absolutely no benefit when you're putting it on Schedule A, where you itemize your deductions for those income taxes. When you elect pass-through entity tax, you're actually able to take this tax and you're able to shift it to the burden of the entity. So the entity pays it on your behalf or on the individual or state trust and estate behalf. Of course, that's pretty obvious with the name pass-through entity tax. However, what happens is you get a credit on your individual state tax return. However, the big kicker is that you get a deduction, an ordinary business deduction on your federal return. So instead of going on Schedule A, where you are subject to that $10,000 cap, it goes to your page 1 of the 1040, where you're able to deduct that in full against any other income that you have or deductions, and it comes to your taxable income. It's possible that this will sunset in some states. It's possible that some states will keep it. Just depends on where you are, but it's an excellent tool to be able to save some money federally. Moving on to some retirement plans and opportunities here. New in 2023 was the qualified student loan matching opportunity here. So this is a tax deductible benefit that will kind of supplement that tuition reimbursement deduction. For any of you familiar with it, it's been, I think, about $5,800 a year for as long as I can remember here. So it hasn't moved much. So this is just one way that employers can actually match payments on student loans with contributions to retirement accounts. Qualified contributions can be made to, on the bottom here, 401ks, 403bs, simple IRA plans. And it's just another way marginally to kind of attract younger talent or to provide an opportunity for folks to pay off their debt and also save for retirement at the same time. Looking at a couple of different types of plans here, defined contribution plan. This is pretty run of the mill. It doesn't promise a specific benefit at retirement. Employer, employee, or both can contribute. I'm sure this sounds very familiar. It's your typical 401k or 403b. What I wanted to discuss today briefly was SEP IRAs, Simplified Employee Pensions. So these are relatively easy to set up. They're low to no cost, but they provide opportunities for business owners who say they have a highly profitable business. They are either a sole proprietor or they are a partner in a partnership where there are little to no employees. Obviously, no employees is ideal in this particular case. You're able to sock away up to $69,000 per partner or as a sole proprietor in any given year to defer tax on any income and to contribute to this SEP IRA. It's an excellent tool if you are making high profits and you just need a place to put money away, and you're also saying to yourself, 401ks are expensive. There's 2 of us. Why am I doing this? So it's just a great way, low, no cost way to set yourself up in the future. We have defined benefit plans, which is kind of contrary to the defined contribution plan. This is historically speaking and more popular, the word pension. And we all know that that's more of a dying breed as far as retirement plans go. It provides this fixed pre-established benefit for employees at retirement. It's an excellent retirement gift kind of in a way. But one thing that we don't often hear about is cash balance plans. So this is a type of defined benefit plan. We usually look at these as a really great savings opportunity for business owners who are single member entities or very few owners, but they're highly profitable. So, if you're on the latter portion of your working years, but, you've managed to increase your profitability and you're trying to put away for retirement, this plan actually allows you to put up to $275,000 per employee per year in 2024. So that's an immense savings or tax deferral, that you can reap the benefit of if you are in that position. Of course, with that large outsized pro, the other side of it is the most costly and administrative administratively complex retirement plan to enact. It has these filings, actuarial, tax related, and there's possible excise tax associated with them. But our wealth management team, they have worked to set up some of these plans and they're familiar with them. And certainly it's a great thing to take advantage of. As far as the various plan limits, just wanted to put this in front of everyone just to see the outsized benefit that you get with either a defined benefit plan at the 275 we were just talking about, or with defined contribution plans with that SEP IRA up to $69,000. The $69,000, I do want to caveat and say that is a function of your business income. So if you make $69,000, you don't get to put the entire thing away. So consulting with that with your tax professional advisor would be an ideal situation. Finally, which I'm sure as many business owners that are on here know, the Corporate Transparency Act. This started this year, January 1st. And it requires business owners to either define whether they are exempt from the filing or to file a beneficial ownership information report. I won't go into too much detail, but I will say that AAFCPAs has put together a task force for this. We've studied it, and we have this great resource available to you if you are unsure of your filing requirements and you would like some consultative advice. We also have some blogs on it if you are interested in some self-service. So with that, I will hand this over to Rich to close us out today.
Great. Thanks, Tyler. Great information. Just a couple of quick comments. Many of the items that were touched upon, including research and development, capitalization, state and local tax, as well as international tax, was discussed yesterday during our business webinar. So I'd highly recommend you're viewing that once it's made available for download. With regard to the Corporate Transparency Act, I'll bring up a question that came up yesterday. If you've created a new entity in 2024, you have 90 days to file. If you create that new entity in 2025, you have a 30-day window. Entities in existence prior to 2024 have until the end of December. With regard to transaction advisory and selling a business, oftentimes in the asset versus stock question, the parties look to negotiate some kind of tax equalization payment so that the owner is made whole for any increased taxes that arise as a result of a buyer's preference for asset sale treatment on the transaction. I'd like to thank Dan, John, Josh, and Tyler for sharing their insights today. There's a lot to consider in year-end tax planning. However, AAFCPAs wishes to remind you that financial and tax planning are a year-round exercise. Issues and opportunities can creep up on you at any time during the year, and those will have tax and financial implications. We wish to thank you for spending your precious time with us today, learning what you need to know. We welcome the opportunity to help you map out a tax plan that takes full advantage of all strategies that are available to you. And as always, we look forward to your feedback. If you have any specific questions regarding today's session, please reach out to your AAFCPA's tax partner or any of today's speakers. We're here to help.